Welcome to The Explainer. Okay, let's dive right into this. Have you ever looked at the thousands of mutual funds out there and felt just completely overwhelmed? It often feels like you're trying to read a dry, complicated textbook, right? Well, today we're going to flip the script entirely. We are going to treat mutual fund selection like a matchmaking process. We're building a straightforward, logical framework to help you find the absolute perfect match for your money.
To find that perfect match, we're going to use what we call the funnel method. Here's our roadmap. We'll start with knowing your risk profile, then look at the risk-return hierarchy, choose some investment strategies, evaluate fund performance, and finish up with some smart selection rules.
So let's jump straight into step one, knowing your risk profile. Look, before you even think about picking a specific fund, you absolutely have to know yourself, your goals, your timeline. It is the bedrock of all this. Now, there's this massive myth out there that age is the ultimate deciding factor, right? Like young people take wild risks and older people play it safe. Let's completely debunk that right now. You could have two 30-year-olds with totally different goals. One is stashing cash for retirement 3 decades away, while the other just needs a house down payment by next year. It's really about your actual need, your financial ability, your mental willingness to take risks, and your time horizon. Those are way more important than just the year you were born.
And this brings us to a really brilliant way to structure things, the core and satellite approach. Think of the 80% core as your reliable engine. This part is strictly for your long-term needs. It's steady, it's dependable. Then you've got that 20% satellite portion. That's your tactical wing. It's where you can be a bit more opportunistic, maybe try to catch some short-term market movements or dive into specific sectors. It perfectly balances that rock-solid stability with just a little bit of opportunistic growth.
All right, moving down the funnel to step 2, the risk-return hierarchy. Now that you know what you're looking for, it's time to survey the dating pool of asset classes. As we step through these, starting at liquid funds, moving to debt, then hybrid, and finally equity, there's an absolute golden rule of finance at play here. As you move up that ladder, both your potential risk and your potential return increase hand in hand. Liquid funds, great for safely parking cash for a few weeks with practically zero volatility. But equity funds, that's where long-term wealth creation happens. Assuming, of course, you can stomach the market roller coaster. Let's zoom in on equity funds for a second because there's actually a hierarchy hidden in here too. Large cap companies are your established giants, steady revenues, lowest equity risk. But as you move down to mid and small caps, the whole dynamic shifts. Small caps are right at the starting line of their growth. During a booming economy, they can absolutely skyrocket. But, and this is a big but, they often lack the financial armor to survive an economic deep freeze compared to those large cap heavyweights. Bottom line, higher potential reward always means higher potential risk.
Which naturally leads us to step 3, choosing investment strategies. This is where you figure out your specific type. First up in the arena, we have active versus passive funds. Active funds have a manager who is actively trying to pick winning stocks, trying to outsmart the benchmark. Naturally, you're paying higher management fees for that brainpower, and it definitely carries higher risk. On the flip side, passive funds like your standard index funds just mirror the market. Boom. No manager selection risk and the costs are significantly lower. What's crucial to grasp here is that paying top dollar for an active fund literally does not guarantee better returns. If you're just looking for steady, no-stress equity exposure, passive funds are an incredibly smart play.
Then we need to look at the actual mechanics of how you buy in. Open-ended funds are highly liquid. You can pull your money out at the current net asset value, or NAV, pretty much whenever. But to do that, the fund has to keep a chunk of cash sitting around, which can honestly drag down your returns a bit. Closed-ended funds, though, lock your money in until maturity. I know, locked sounds scary, but it actually gives a fund manager the freedom to invest in highly profitable, illiquid stocks without having a panic attack about investors suddenly demanding all their cash back.
Now, what's really interesting about this next comparison is how growth and value strategies are built for completely different economic weather. A growth strategy hunts for companies expanding faster than the overall economy. These guys absolutely thrive in a roaring bull market. A value strategy, though, that's pure bargain hunting. It's looking for underpriced stocks, just sitting there waiting for the broader market to wake up and realize their worth. And interestingly enough, value funds actually tend to outperform in falling bear markets. Depending on your risk appetite, both of these can absolutely earn a spot in your core portfolio.
I absolutely love this quote. Diversification is a protection against ignorance. It just hits the nail on the head. Listen, if you go all in on highly concentrated sector or thematic funds, say a fund that only buys pharmaceutical stocks, you're making a massive high-stakes bet. You have to perfectly time when to get in before the boom and exactly when to bail before the bust. Diversified funds spread that risk out. They protect you when you aren't 100% sure what the future holds, which, let's be honest, is literally all the time.
Okay, step 4, evaluating fund performance.
So, you've found a category that fits your vibe. Now we run the background check. When you're looking at past performance for an equity fund, the magic number is 5. 5 years is the absolute minimum window you should look at. Why? Well, if you only look at the last 12 months, you might just be looking at a lucky streak in a booming market. A 5-year stretch pretty much guarantees you'll see how that fund and its manager handled the really good times and the really bad times. Now, for short-term debt funds, you can usually get away with a 3-year window.
Here's another crucial metric you really can't ignore: the portfolio turnover ratio. In plain English, this tells you how often the manager is buying and selling or churning the stocks in the portfolio. So why does this matter to you? Simple. Every single time they hit buy or sell, it costs money in brokerage fees. High turnover means high costs, and those costs are eating straight into your returns. You want a manager whose trading style actually aligns with what the fund is trying to achieve, not someone day trading with your retirement.
We also have to talk about the sheer size of the fund. Now, a massive fund size is usually great for large cap funds. You get those nice economies of scale. But for mid and small cap funds, having too much cash can actually be a huge disadvantage. The pool of good small cap investments is pretty small. If that fund gets too bloated, the manager might be forced to just dump money into subpar companies just to get it off their desk. Often, a smaller fund is way more agile and better at snapping up quick market opportunities.
All right, bringing it home with Step 5, Smart Selection Rules. This is where we cover the major red flags and the golden rules to keep you out of trouble. First up, the biggest trap in the whole financial world: chasing past performance. Seriously, just because a fund was the darling of the market last year does not mean it won't tank next year. You also need to keep a hawk eye out for hidden wealth killers. I'm talking exit loads if you pull your money out too early, capital gains taxes, dividend taxes. What looks like a blockbuster return on a shiny marketing brochure can get slashed by these very real-world costs. And it goes without saying, beware of sketchy distributor practices. Always make sure whoever is advising you is actually acting in your best interest.
The ultimate antidote to all that market noise is surprisingly simple. Write it down. Develop a consistent, written methodology for how you select your schemes. When it's on paper, you stay on course. It forces you to stick to your core asset allocation instead of, panic buying whatever trendy investment fad is making headlines today.
So the crucial point boils down to this one question. Are you just chasing past performance, or are you actually building a portfolio for your future? When you filter your choices through your personal risk profile, understand the risk-return hierarchy, pick a strategy that makes sense, and run a proper background check, you aren't just crossing your fingers and guessing anymore. You are meticulously matching your money to its true purpose. Take this framework, stay disciplined, and go find your perfect financial match. Thanks so much for joining me for this explainer, and keep learning.